Hello, everyone, and welcome back to the world's best investing podcast. Today, I'm going to be taking you through my Tesla Q1 2025 earnings report digest. Now, at first glance, the numbers seem terrible. Tesla's automotive sales are down big time quarter over quarter. You've all seen that graph, and everyone's knee-jerk reaction was to say, well, Tesla is going down the drain with Elon focusing on Doge. But actually, if you dig deep into the report, you will see that the Tesla automotive sales are down considerably because during Q1, they were actually just rebuilding factories in order to get better at producing the Model Y, which is obviously their best-selling car. So the numbers are down for that reason. And really, if you take a step back, this is what the Tesla thesis is for me, and I think for the majority of long-term Tesla shareholders. By the way, if you're wondering why you should listen to me, well, I'm up 20x on Tesla. So I know something about being a long-term Tesla shareholder. And before we get deep into the thesis and into what Q1 2025 means, remember that yesterday I made available 15 discount coupons to obtain lifetime access to my course for $299 instead of $350. Now there's only 3 coupons left. You guys snatched them up like lions. And remember that once you get lifetime access to my course, that includes all future versions, which I'm always iterating on the course, and it gives you access to my Slack community for free with more than 280 international investors that you can talk to that have taken the course. So tremendous value on top of the actual course. The link to the course is in the show's footnotes down here. Use code PLTR at checkout and you get the discount. So back to the Tesla thesis. If you take a step back, how do Tesla shareholders make a lot of money going forward? Well, that is if Tesla is the company that births physical AI. So if they are the company that solves autonomy, not just for cars, but for everything else, and they repackage that in a way that anyone can access autonomy by connecting to an API, then these guys are golden. Then this company becomes a multi-trillion dollar company. People say, well, they often ask me, how can you possibly believe that Palantir and Tesla are going to be $20 trillion kind of companies in the future? That's bigger than the GDP. Yes, but the GDP in 2 or 3 decades' time is going to be much, much bigger. And it just shows people don't really think long term. The reason I'm able to do this now full time and be in this rather privileged position is that I think long term. I've been a Tesla shareholder for, I think, just under 9 years now. AMD shareholder for over 10. So I think very, very long term, and it's something that's not natural to people. But anyway, Tesla shareholders make a lot of money if Tesla is the company that births the leading physical AI. How do they come to do that? Well, it's really just about putting more cars on the road than anyone else that are connected to a vertically integrated infrastructure, such that every car that's driving around ultimately generates data that gets sent back to a data center where it gets processed and gets converted into insights, so that basically my light is failing again. Sorry, guys. So that all that data gets ultimately translates into a better autonomous car. And so basically the more cars Tesla puts on the road and the more data they generate, the more of an advantage they have over whoever the next competitor is in the race towards physical AI. Now, really what's important there is the cost with which Tesla is producing cars. Because as the cost goes down, the scale of Tesla's auto operation is going to go up. Yes, Tesla's auto margins are going down, but we'll see now why actually that's a good thing. But just focus for a minute on the idea of the cost and why that is important. Basically, if Tesla ever makes a car which is, goes for something like $10,000, which they will, very likely, or, if you want to be more reasonable in the short term, something more like that. But essentially, Tesla is going down that direction. It's a no-brainer to buy a Tesla. If it's autonomous, runs on, it's cheaper than gasoline, etc., has tremendous autonomy, and generally offers a total lower cost of ownership compared to other cars, then it's a no-brainer. This thing gets tremendous scale. So then really, if you think about, of course, the big prize is physical AI. But for another company to come and snatch that price from Tesla, that long-term reward, they have to compete with Tesla in terms of manufacturing. And although Q1, the numbers are not great, I actually think that Tesla continues to make tremendous progress in that direction. So let me explain why. Actually, before that, some people believe that the decline in automotive sales in Q1 is due to the brand damage thing. And actually, it was interesting to see Elon say a number of things. One, in Q1, they had a record number of test drives globally. So, I mean, of course, none of that is good for the brand, the people sabotaging Teslas and stuff. He says they're paid. It could be anything. But it's a little bit like global warming. No one really believes it. And it's just people that have an economic interest in it that really pursue it to death, right? So record number of test drives globally in Q1 means that I wouldn't say the brand is being too damaged. And I guess if you buy into this sort of thing, you sort of also buy into the Ukraine thing, global warming. It's like, look, I mean, people just want value for a fair price. And if they get that, nothing stops them. So I don't really think the brand is being damaged. I could be wrong. Of course, none of this is financial advice. I always have to say that. But I think that the brand is doing just fine. And so qualitatively in the earnings call, management reiterated numerous times that they're actually focusing on the low cost of ownership. And so they expect to release new models by the end of the year. And so the earnings call was focused on that. So it's like I was talking about this in my Costco video, the last one, when I was talking about Costco. You don't always get perfect information quarterly. But what you do want to see is a management team whereby the qualitative and the quantitative data points are in symphony and do point towards a company that's focusing on what they really have to focus. So although we don't have data this quarter that's indicative of efficiency gains, and we'll go deep into that now, I'm going to show you a metric which no one really pays attention to. We do have all this qualitative data. Management reiterating numerous times that they are focusing on reducing the total cost of ownership and enhancing the manufacturing efficiency, namely by basically revamping all their manufacturing processes in order to bring the new models to life. Now, on its own, those remarks by management mean nothing to me, but this is a company with a track record of doing just that. So Tesla stock got to be very hot in 2021 because for the past, during the previous few years, they were focusing on enhancing their manufacturing in order to bring the Model 3 to life, what Elon Musk termed production hell. And they did it. And so ultimately, free cash flow per share went through the roof. And so what I think is happening now is that qualitatively, we're in the same kind of process. Tesla is focusing on bringing new models to the market, and that's all they really talk about in the quarterly conference call in Q1 2025. They mentioned that in Tesla Shanghai, they produce one car every 33 seconds. And this new manufacturing method called Unboxed, which is, it's an interesting name because it would remind you of unboxing a product, but they call it that. They expect to produce one car every 5 seconds in every single Tesla plant once Unboxed has been unleashed fully, right? And so it just shows you how focused these guys are. So in terms of, yes, the quarter is not great. Q1 is seasonally bad. People don't buy cars during the winter. I think they do so when they get more excited about life. So generally in the warmer months and stuff. But what we have is a management team focused on what really matters, which is dropping the total cost of ownership and enhancing manufacturing efficiency. Now, you guys should check out my written updates for Q1 2025 because you're going to see all the details and all the graphs that sort of paint this picture. And I'm gonna talk now about something which I think is very interesting. It's a metric that people don't really look at, which is Tesla's operating cash flow divided by capex. Operating cash flow divided by capex tells you how much cash from operations the company is producing per dollar that Tesla reinvests in the business. And so if you see the graph in the written form of the update, which is you can access in the show's footnotes for free, so the link is down here, you will see that it's cyclical. It goes up and down. No one talks about this. The reason for which it goes up and down is that every time Tesla attains a relatively high, a new efficiency record, which really, the metric, again, operating cash flow divided by capex, really when it goes above 2.5, what Tesla does is drop prices. And you can see the metric going down again. So the amount of cash flow that they produce per unit of capex trends down because what they're doing is sharing economies of scale. I was talking about the importance of doing this in order to create monstrous companies. It's the most powerful force in capitalism. And so what's happened over the past few years, from 2022 onwards, is that Tesla has been dealing with two macro headwinds, which is one, much higher price of money, arguably infinitely higher. So rates have gone from 0 to wherever they are now, 4% or whatever, 5% over the past few years, and inflation. And so that's made cars far less affordable. So if you look at the graph, it would seem like Tesla's not actually gaining much efficiency, because operating cash flow divided by capex is actually relatively flat since the uptick that we saw in Q4 2023. Again, I can't recommend you enough to go and check out this graph in the written form, because it's beautiful. And it's something that really people don't talk about, and it gives you so much depth when analyzing this company. The thing is that if you actually normalize this graph for the price of money, what we see now, although it looks flat on average, and again, the data point in Q1 2025 is somewhat invalidated because they stopped production at the factories, and then in Q1 2024 we had the Houthi attack, so that was invalidated too. It's roughly flat from Q4 2023 to Q1 2025. If you normalize it for the price of money, which is much higher, the efficiency is actually way above where Tesla was before 2022. And so what that means is that actually, once Tesla releases their new vehicles, I think we're going to see something like what we saw in the year 2020 when Tesla went up 10x when they brought the Model 3 to life. So Tesla is very, very focused on bringing these models to the market. They're going to be much cheaper and they're going to operate at a much higher scale. And so that does two things, which is one, produce more free cash flow per share on its own by the merits of the manufacturing prowess, as happened with the Model 3. And then it dramatically enhances Tesla's moat when it comes to birthing physical AI, because what they're doing now, I mean, look, we're going to talk about the margins now, and it's very interesting. They're going down, and I actually think it's a good thing. It's something that people don't really understand. But essentially, the headwinds that Tesla has been facing over the past few years, every single company on earth has been facing. And we've actually seen other OEMs scaling back in the... Sorry, I'm getting a call again. Sí, ya está puesto. Estoy grabando un video. This is gonna turn into a classic. Fuck's sake. Anyways, all these other companies are facing the same problem, and they're scaling back their EVs. Now, EVs alone, I'm not a religious EV fan, so EVs can do whatever they want. I don't really care about EVs per se, but really, EVs are kind of the gateway for OEMs and other startups like Rivian, etc., in order for them to create software-defined vehicles. So it kind of goes hand in hand. These guys are scaling that back. They are so far away from Tesla in that sense. And the headwinds that are negatively affecting Tesla's financials, because ultimately the income statement has simply been going sideways for years, that is setting all these companies back too. But Tesla is actually pushing ahead. And so actually I think their moat is getting stronger. I'm gonna give you another reason for which I think the moat is getting stronger now. But so yeah, go and check out that graph. It's very, very interesting. Now, they're planning on releasing the new models towards the end of this year. And so I believe towards the end of this year, maybe going into the second half of 2026, I believe we see something like a Model 3 kind of moment on the manufacturing side alone. Now, if you look at the FSD videos of these cars driving around on their own, they really drive themselves. And so that's something that, I think the masses have an ability to sometimes ignore facts as they happen. And obviously these cars are driving themselves. And it's a very unique thing to Tesla, at least in the West. And so this is the company that's leading physical AI in the West, which, I think the price is going to be huge. Now, if you refer to the written form of the write-up, you're going to see that Tesla's gross margins and cash from operations are actually trending in opposite directions since around, I'd say, mid-2024. There's been a little bit of an inflection point. So gross margins are going down and cash from operations are going up. Your entry-level analyst will say that's a bad thing because gross margins are going down. But as Jeff Bezos once said, investors can't spend percentage margins, but they can spend free cash flow. And so you as an investor, you don't actually care about gross margins in the sense that they're not actually what makes your shares valuable. So if a company prints more free cash flow or more cash from operations per unit of gross margin, that means the company is more valuable to you as a shareholder, and it gets harder to replicate for competitors. Because if Tesla's gross margin goes down and the amount of cash that they produce per unit of gross margin goes up, means Tesla is getting more profitable with a lower margin. Meaning that for someone else to compete, they have to go below that hurdle of the declining gross margin. And so it just makes it harder for competitors to emulate Tesla's business while producing enough cash to stay afloat. So for me, as a Tesla shareholder, if I want this thing to go up 10-fold in value or 20-fold or whatever, I want the whole hardware business to have 0% margins, ideally at the limit, so that really no one else can come and compete with this company. Or just say, maybe take it to the extreme, 1% gross margins. If Tesla manages to sell millions and millions of cars with a 1% gross margin and still produce free cash flow, then it means no one else is really going to be able to replicate the vertically integrated infrastructure that you need to birth physical AI. Do you see what I mean? So, there's this bifurcation in the market of people that see Tesla as a car company and people that don't. The bifurcation is interesting, but in order to make money going forward, this thing has to evolve in the direction, or continue evolving in the direction of not being a car company. So what we want is maximum scale, minimum gross margins, maximum cash flow production. And what that does is just make the whole operation much, much harder to replicate. And obviously, if you look at businesses like Amazon, Walmart, potentially Costco, all these kinds of huge beasts that are prime examples of economies of scale shared and are largely undisruptable via today's technological means, that's what they do. They squeeze competitors out of the market by minimizing their margins and ultimately seek to produce the most amount of cash flow per unit of gross margin. What Tesla is doing, if you look at the cash from operations graph, which I'm looking at now on my write-up, it's very interesting that it's way above 2022 levels, although actually the auto sales are lower. So that's very interesting. What this tells you, this company is getting much, much, much more efficient than people currently understand. And the shares were actually up after the earnings report, and people believe that is because Elon is coming back, which does help. But I think what the market is really pricing in here is the fact that this company is getting pretty efficient. So again, as I was saying, once they release the new models, I think the stock is going to go to the races. But the gross margin thing is very interesting. Then the next graph that I'm looking at now, which you guys have to see this right up because we go into so much detail here. Energy storage deployments are growing exponentially. And so Elon talks about something in the earnings call, which is very interesting, which is he basically says that megapacks enable utility companies to produce energy during the night as well as during the day as they do at present. Meaning that, these utility companies can't produce during the night because they don't have anywhere to send that energy off profitably to. But basically they can now produce energy at night and store it in a megapack and then sell it during the day. So basically megapack has this tremendous application, which is really to double the output of the utility sector. And so he believes that can take the business to the terawatt scale per year. So I think that if you look at this graph, it's beautiful. It's scaling exponentially. And I think this is going to go very, very far because these guys, what they excel at as an organization is basically iterative technology curves. If they do batteries, they just do them better over time and cheaper. If they do cars, they do them better and cheaper. If they do AI, they do it better and cheaper, etc. So this company is not only getting more efficient in terms of manufacturing, that is spilling over into the energy business, as I've been saying for years. And obviously the AI thing is working because FSD drives itself. I don't know how to state this, but it really, these cars drive themselves. And so what you see is the three curves, which are really the cornerstone of my Tesla thesis. We have manufacturing, energy, and AI. And Tesla is compounding these three curves at a rate which no other company is on planet Earth. And so at some point, the odds of those three curves combining into a platform that ultimately unlocks some form of material abundance are meaningful enough. Now, if you look at the cash flows, as I was saying, they are higher than they were in 2022 with lower auto sales. What else do you need to understand about this company? It's just getting much more efficient. And then if you look at the balance sheet, the cash position is roughly 3 times the total debt. And so what I think we're looking at here is a highly asymmetric situation in which success is not guaranteed. That's why you have a portfolio. But ultimately, if someone can birth physical AI at scale, so autonomy, and not just for cars, but for anything else, ultimately Optimus, etc., it's Tesla. And financially, this company remains very strong, even though they are facing tremendous headwinds, which is, as I was saying, everyone else is facing. But what they are doing is falling behind, and Tesla's pushing ahead. So really, my view is that as these new models come to the market, I believe we're going to see free cash flow rise very quickly. And I believe that's going to further accelerate the AI thing to the point that these cars are really going to drive themselves completely by themselves. Like, you're going to be able to fall asleep maybe in 2 or 3 years and just completely trust the car. So I remain long this company. I've been so since 2016. And I think this is going to be, I love the odds. I love the odds here, and I think that people have gotten very depressed with this company over the past few months. It's nice that we've gone through I won't say, again, I don't want to say the C word, but because this is on YouTube, we've gone through a very high VIX recently. And still, this thing was trading at around $250, a little bit less, a little bit more. So you kind of know where the floor is now, and I think that this is looking very asymmetric. So guys, if you want to read my Q1 update in depth, go check it out on my Substack. It's linked to in the show's footnotes. It's a beautiful write-up. You're going to love it. You have all the graphs there. This is really information that obviously it's not being shared anywhere else. I don't see anyone else focusing on operating cash flow divided by capex. I don't see anyone making the assessment about gross margins that I am. Again, knee-jerk reaction, gross margins go down, that's a bad thing. But not really, because this company has less auto sales, but much higher cash flow with lower margins. That's tremendous. That means the moat is getting much stronger. So guys, thank you very much for joining me today. If you enjoyed this update, could you please share this with one friend? These deep dives are for free, and so the only way this grows is with your help. Thank you very much for joining me today. Apologies for my runny throat. It's hay fever season. I'm going to have to leave Madrid off to the beach for good. This is going to get bad. But anyways, guys, see you next time and take care.